Hey everyone, and welcome. Today we are diving deep into the anatomy of a massive crypto crash. One of those crashes that just sent shockwaves through the entire market. Bitcoin tanked, altcoins went right down with it, and billions, with a B, of dollars were just wiped out in a blink. So how on earth did that happen? Let's get into it. To really get a sense of the sheer scale of this collapse, just look at this number. We're talking about $1.8 billion. That's how much value in leveraged positions was forcibly liquidated. Just poof, gone, in a single 24-hour period. It was this absolutely brutal, cascading failure that left so many investors just reeling. So that leads us to the big question, right? Why? What, or maybe who, was behind this absolute market meltdown? Was it just one thing, some kind of black swan event nobody saw coming? Well, the sources we looked at suggested is way more complicated than that. So we're going to play detective, follow the clues, and piece this whole story together. Yeah, what we're really looking at here wasn't some single isolated event. It was a perfect storm. I mean, a truly brutal combination of shocks coming from the outside world of traditional finance, some really deep-seated weaknesses inside the crypto market itself, and, believe it or not, a surprising dose of high-stakes political drama. Let's break it down. So our investigation actually starts not in the world of crypto, but in Washington, D.C. This is where a few key macroeconomic tremors started to create the first cracks in the foundation, sending these waves of fear through pretty much every financial market out there, and crypto was right in the path. Now, what's so wild is how just one single personnel change can completely rattle global markets. The nomination of Kevin Warsh to lead the U.S. Federal Reserve, that was a huge catalyst. You see, the market was kind of hoping for business as usual, stable policy, low rates, lots of money flowing. But Warsh, he's known as a hawk. And that one word signaled this dramatic shift to a whole new reality. All of a sudden, there were fears of monetary tightening, higher interest rates, less money in circulation. For a risky asset class like crypto, that is a massive flashing red flag. And that Fed news, it didn't happen in a vacuum. It was piled on top of a U.S. government shutdown, which, injected a huge dose of political instability into the whole mix. Then you add on rising geopolitical tensions around Iran, plus growing worries about U.S. inflation, and suddenly you've got this potent cocktail of fear that had investors just running for the hills. It was a classic risk-off environment, as they say. Okay, so the pressure from the outside was immense. We get that. But why did the crypto market itself crumble so spectacularly? Well, for that answer, we've got to look inward. We need to look at the structural weaknesses that made the entire system just incredibly fragile. Like a house of cards, just waiting for the slightest breeze to knock it all down. And this right here, this was the engine of the crash. Forced liquidations. Seriously, think of it like a line of dominoes. The first price drop knocks over the first one. That's an investor who borrowed money to bet on prices going up, and boom, they get automatically sold out. That sale pushes the price down even more, which knocks over the next domino and the next one and the next. It's this vicious, self-feeding cycle that just puts the crash into hyperdrive. So why did the dominoes start falling? Well, because the big money was already sneaking out the back door. If you look at this chart, you can just see the massive outflows from Bitcoin ETFs, which are a really popular way for big institutions to get into Bitcoin. A jaw-dropping $818 million was pulled out in just one day. That's that first SPAR. And it was part of a $1.6 billion exodus for the month. The big takeaway here is that while a lot of people were still bullish, the so-called smart money was quietly and very quickly leaving the building. Digging into the blockchain data itself, what we call on-chain data, showed another really troubling trend. We saw this clear divide between the whales, the huge, sophisticated investors, and retail, which is all the smaller, everyday investors. On the left, you can see the whales were selling, and they were selling heavily. One analysis even found that around 600 of these big wallets just disappeared. But at the exact same time, on the right, retail investors were buying. They were buying the dip, hoping to catch the bottom. In a healthy market, you really want to see the opposite of that. This was a huge warning sign. So who exactly was creating all this selling pressure? Well, it wasn't just one group of people. As you can see here, it was kind of a three-pronged attack. First, you had those huge institutional ETF outflows we just talked about. Then you had the long-term holders who were finally deciding to take their profits or maybe just cut their losses. And on top of all that, you even had crypto miners selling off their holdings just to cover their operational costs. All three were hitting the sell button at the same time, and it just completely overwhelmed the market. Okay, so we've covered the macro fears and the internal weaknesses. But our sources point to one final, and frankly, deeply unsettling piece of this puzzle. It's this tangled web of political deal-making and regulatory uncertainty that just added a completely new and unpredictable layer of risk into the whole situation. This quote from legal ethics expert Kathleen Clark, wow, it really captures the seriousness of what the Wall Street Journal was reporting. She called it a 5-alarm fire that the federal government is for sale. And that really sets the stage for a series of events that raise some serious conflict of interest questions, blurring the lines between private business, foreign governments, and U.S. policy. All right, I want to be crystal clear here. We are simply reporting the sequence of events as they were laid out in the source material. So get this, just 4 days before the presidential inauguration, a UAE royal investment firm reportedly agrees to a $500 million investment in a crypto project linked to the Trump family. Okay, then, a short time later, the U.S. government eases export restrictions on advanced AI chips to the UAE. Then, a related firm from the UAE invests $2 billion into the crypto exchange Binance. And to cap it all off, President Trump later pardons the founder of Binance, Changpeng Zhao. For any investor watching this unfold, this sequence just screamed unpredictability and raised massive concerns about what the government might do next. So, let's connect all the dots. We've looked at the shocks from the outside, the fragility on the inside, and this political wildcard. It's time to put it all together and deliver the final verdict on what really caused this historic crash. So in the end, it wasn't just one thing. It was the collision of 4 really powerful forces. You had this blanket of macroeconomic fear coming out of Washington, creating the storm clouds. You had the big institutional money running for cover. The crypto market itself was basically a tinderbox of high leverage, just ready to ignite. And then this new, unpredictable wind of political uncertainty started to blow. When all of those forces came together, they didn't just cause a storm, they created a hurricane. So what's the big takeaway here? Look, the crypto market is no stranger to volatility. It has crashed and burned and recovered many, many times. But this one feels different. The fact that it's now so tangled up with mainstream monetary policy, institutional finance, and now these complex international politics, it suggests we're in a new era. And it leaves us with this really critical question. Has the game for crypto fundamentally changed for good?